Welcome to Real Estate Economics webinar series. Real Estate Economics is a leading provider of residential market consulting services and online research tools. Real Estate Economics webinar series cover a variety of topics of interest to the home building, land development, private equity, lending industries, and to interested participants in public and private sectors. I'm John Mulville, Vice President of Consulting at Real Estate Economics, and I'll be presenting today's overview of the Bay Area of California. I'll provide contact information at the end of this webinar. If you have any questions, you can feel free to call. You can always find the webinar schedules on our website, www.realestateeconomics.com. 2 weeks, we'll provide a webinar for the Seattle housing market. 1 week after that, we'll be introducing our new website, and on December 15th, we'll be providing a national recap. To watch any past webinars, access our YouTube channel at www.youtube.com, then Real Estate Economics all spelled out. There's a link at the top labeled All, ALL. It will list all of our past presentations, so click the link and the presentation you want to watch will start. Let's look at the Bay Area, current conditions and 5-year forecast. This is an area with a very volatile and highly oscillating employment profile. You can see here employment's been significantly under 3 million during the 1990s, surging to about 3.6 million in the year 2000, only to fall back to a current number presently of about 3.138 million. When capital costs are cheap, as they were in the Greenspan era, as they are today, a lot of capital will flow into capital-intensive industries, all very logical. So when money's cheap and when we have quantitative easing like we have today, high-tech sectors and sectors that require a lot of capital investment tend to benefit. That's certainly the case today. As this market oscillates in terms of employment, quite a few people have moved into and out of this market. The demographic and population data showed tremendous surges during the dot-com era. The high-tech worker tends to be highly mobile and moves around a lot in search of opportunities. Many of the jobs, of course, are high-paying jobs, and this area has international draw in terms of pulling employees from around the world with the specialized skills needed to advance the wireless and internet infrastructure industries. You can see how the employment's oscillated here in this particular chart. There's been 2 periods, 2001 through 2004, and then another 3-year period, 2008 through 2010, where this area has lost more than 200,000 jobs in a couple of year period. We had a little rebound in between, but this just goes to the cyclical nature of, one, the technology industry, but also, two, we've had several periods of easy money in the last decade that have outlet themselves to the technology area. This area has a tremendous potential to catch a lot of these jobs back in the 5-year forecast period. We know that the wireless industries and all the mobile on demand and this sort of thing are creating large employment bases, large number of new jobs with high-tech companies. At the same time, we've got to acknowledge there's headwinds in the public sector, with job losses almost seemingly certain at this point in education, government, some healthcare fields, simply due to California's very difficult budget situation. If you look at the unemployment history over this area, you can see in the late 90s we were as low as 3.2%, doubling that when the air came out of the dot-com bubble, returning to very low levels in 2006 and 2007 before the last recession, and continuing market disruption led us far over 10%. California has been a state that has tended to continue to have fairly weak employment conditions, even as much of the nation has improved. We've got some very strong pockets. We've got some pockets that are proving to be very resilient and adaptive. At the same time, we have some areas that aren't growing very well. So California has been sinking lower in terms of its poor performance on unemployment several states, even the Michigans and some of the South Carolina and some of the other places that have had very difficult unemployment profiles have been doing a little bit better than California. Let's look at the housing permit activity in this area. The dark blue is the single family activity. The light blue on the top of the bars is the multifamily activity. Obviously this area is highly urbanized, so multifamily and condo activity is better here than it is in many places. High costs, high commuting costs, just the demographic has been very supportive of multifamily in this area. There are some difficulties on the multifamily side as we see it now, with high construction costs, high levels of municipal exactions, that sort of thing. The single family, much of that demand has flowed out to the suburbs and more remote areas, more difficult to access but lower price points. The 2009 permit data is barely over 5,000 permits. That's not nearly enough to maintain a stable housing stock in a market of this size. Every year there are units lost to demolition, sometimes for larger developments. Sometimes units are converted to office, medical office, retail, or just a variety of other uses. So to maintain a steady single family stock, you really need more than 5,000 permits a year. At 5,000 permits, the employment base here is much, much larger than it was 20 years ago. It's grown about 10% in that time period, so these low level of permits are really not keeping up. But we've got good growth coming in the 5-year forecast period with improving employment. You can see how slow and measured the increase in the housing stock is in this particular graph. Even in strong years, when the economy is very vibrant, the housing stock tends to grow very slowly. As we all recognize, it's difficult to acquire land, to advance a development plan, gain the entitlements, and design a viable product and get those homes sold. So almost under any circumstance, the housing stock grows very slowly. If you look at the current recessionary period, 2008 and forward, there's barely any growth in the housing stock whatsoever. Here we can see that numerically, year to year, we've been as high as 25 or 30,000 permits when the economy was very strong in the late 90s, now all the way down into the 5,000s with a little bit of growth and recovery in the forecast period. I'm going to take a little bit of a special time here today and talk about mortgage interest rates. We believe interest rates have been in a extended super cycle. If you go back to about 1980, you can see rates peaked during the Carter years and have been gradually coming down over time. Not only have mortgage costs been coming down, but U.S. interest rates really across the yield curve have. Rates were as high as 15% for a 30-year mortgage back in the 1980s, coming all the way down to a current trough in the low 4s. We continue to hear anecdotes about certain programs being under 4%. But we're starting to see a little bit of noise in this market. In some of our past webinars, we've talked about the size of the U.S. Treasury market. It's really one of the largest and most liquid financial markets in the world. And so large markets like this take time to turn, they take time to make changes, and we think that this market's going to kick out a lot of noise and a lot of excitement as it starts to change. So here's a chart of 30-year U.S. Treasury bonds. Now recall that bonds are priced in units plus 30 seconds, so the price on the right-hand scale is, say, 129 and 22 30-seconds. Prices move inversely to yield, so the recent downtrend in price here is a move up in yields, move up in rates, if you will. So you can see this market hit very low rates, high prices back in August and again in October, when the market was concerned that we might be having a double dip recession and that we weren't getting the kind of economic rebound that people expected. But now suddenly we've seen prices drop very dramatically, leading to much higher yields. So you can see the yields in this particular table. We were down as low as about 3.44%. Again, this is 30-year U.S. Treasuries, and now we've run all the way up to about 4.3%, really just in about a 6 or 8 week period. So this market is making some noise. Whether this represents the start of a long-term trend change, we'll have to see. But there are some oscillations here. A lot of money on the QE2 is going into shorter term rates. Not much is coming into longer term rates, and that's been leading to some higher yields in this particular part of the yield curve. That's part 1 of 2 today, so please join us for the second part of today's real estate economics webinar in the San Francisco Bay Area.